Good day, fellow investors. In a recent video with Jeremy Grantham, we discussed how the market is in a bubble and how he said that emerging markets might be really cheap. And as promised, I said I would look at emerging markets, discuss the valuations there, give a comparative overview, and if you get value from this, please click that like button and consider subscribing. Let's start with the content. If we look at emerging markets, we see the stock prices in emerging markets for the global index didn't really explode as it was the case for the S&P 500. We are not up much over the last 20 years, but the S&P 500 really enjoyed this explosion. And if we look at forward price to earnings ratios, we have 22 for the S&P 500, leading to a 4-5% return plus inflation plus growth, 6-7%. And here we have emerging markets with 16, which is around 6%, plus inflation plus growth equal to the S&P 500 likely, if not more due to better economic circumstances, we can get to 10%. Then one could say, okay, emerging markets are better. And if we look at the emerging markets ETF, price earnings 19, in this case for iShares, the dividend yield is 1.45%. And if I compare it to the S&P 500, which has a higher price to earnings ratio, but has a higher dividend. So, okay, we discussed in the weighing versus voting video that dividends are what to be really focused on over the long term, how those grow. And here we have S&P 500 versus emerging markets, different valuations, but similar dividends, which leads to the question, are emerging markets really cheaper? If we go to Star Capital, we have really a great page, Star Capital, for a lot of data, and you have this beautiful chart discussing emerging markets, the markets and the valuations. You can pick the CAPE ratio, the price earnings, price to book, sales, whatever you want, and see what are the prices across the globe. United States of America, 30 price to earnings ratio, cyclically adjusted, really high. Canada also high. Russia just 5.9, ridiculously low. China 18.4. Disclaimer, I'm mostly long Russia because it's the cheapest market, highest dividends. Then India, CAPE 21.3, so as earnings were catching up, actually the CAPE ratio is going down here. And Europe, we have CAPE ratios of 15-7% return, which might explain why people say that European markets might be even better than US markets. And then we have also emerging markets that are not that cheap, or depending on how you look at it. And this is also the key when it comes to just investing into index funds and ETF. In this video we will talk a little bit more about what does it mean, emerging markets, and how those things are weighted in the indices. So if we look at the S&P 500 composition, we have Apple, Microsoft, Amazon, Tesla, Facebook, Alphabet, Google, Berkshire, Johnson, JP Morgan, and the way is there, so big companies, big weights, and then as we go for lower market caps, lower weights. Similarly, also in emerging markets, we have Taiwan Semiconductor Manufacturing. We did a video on it, so you can check it in the link in the description below. Tencent compared, let's say, Facebook plus more, Alibaba compared to Amazon, Samsung Electric, industrial, good, slow grow company, then growth company, this is again Tencent just with a discount, JD competing with Alibaba, NIO competing with Tesla we can say, but a small company compared to Tesla. And I also made a video discussing what's priced in, and Pinduoduo, another company. I'll make a video tomorrow discussing the 10 companies more in detail to see what's in, but I want to just discuss the stock prices here. This is what I want to discuss. When a company has its stock price explode to the upside and the market capitalization reach 2.3 trillion, that's really insane, then if you look at an index fund, then an index fund has to buy more and more of it. And all these companies, no matter which one you look, it has seen an explosion, perhaps not Berkshire or these smaller ones, but these ones have seen an explosion of stock prices. So Apple really exploded, and of course, if we look at NIO, which is 9th on the emerging market, Again, huge explosion. And this is the problem I have with index funds, because they are weighted, they are market capitalization weighted. The bigger the company, the bigger the weight in the index fund. And if we look at these positions, I don't think that this represents well this, because then you have NEO, then you have these companies, and these companies, okay, represent China because now it's the highest market capitalization and perspective, but these companies' price to sales are ridiculous. This, of course, and you will see tomorrow Alibaba is okay, Tencent is okay, but when you buy an index fund, you buy the most expensive things. So emerging markets, this axis here, could be cheap, but not an emerging markets ETF. Also, if you look for exposure, you see that the S&P 500 international exposure is 40%. So great companies, they're expanding globally. So even with the S&P 500, you have global exposure. On the other hand, you have global exposure, but when you look at the weight of the all-country world index, and you see United States are really there on the top of everything, but so does also any ETF have these high skewed weights to the hottest stocks. On the other hand, emerging markets in general should give you a higher long-term benefit, because growth in working population in developed countries, in this case the US, is very low. And if we look at the drivers of growth, the growth in workers and production, it's really declining, let's say, over the last 50 years. And this decline will continue due to population aging. On the other hand, you have emerging markets growth, 50% of GDP growth expected over 5 years for Asia, for example, which is really insane. You have huge new explosions in middle classes. If you look at 1 billion people will be added to the middle class just to 2030, which means huge consumption, huge growth. For 2030, we expect 5.5 billion people spending more and more money and living, let's say, a decent life, which means also that if we look at GDP from 2030, India should really explode GDP. China should be again the dominant force for a while. Then India, other Asia should expand, and all other developed worlds we will contract. So by investing, this is also a conundrum, investing now in developed markets, very expensive, and squeezing in the global wealth pie, let's say. Emerging markets, smaller now, but really expanding. However, as we have seen, there are crazy things in the emerging markets ETF. There are crazy things also in the S&P 500 ETF. We have Tesla, there we have NEO. And of course, something very important, we have fees. Emerging market management fees, 0.7%. S&P is just 0.03%. And if I put this into the compound interest calculator, let's say we start with 10,000, we add 1,000 per month over 20 years, estimated interest rate from, let's say, S&P 500, 8%, same for the emerging markets, interest rate variance, difference in fees, we calculate, and here we are, over 30 years, the difference is approximately, just for the fees, is approximately 200,000, which is 15% of your savings over 30 years, just because you go for the highest fee, which index funds, which always go for the most expensive stock. So we're going to discuss more in detail the individual components tomorrow of the top 10 of the emerging market, but it's another idea that you have to see, okay, emerging markets, it will be okay. I'm not saying it won't be okay, but at this point, perhaps it's better to avoid the exuberance with all the crazy stocks out there that are pushing into the top 10 of an index fund that you are then buying when you buy index funds. Thanks for watching, click that like button, and I'll see you tomorrow.